Here's what we're going to be covering today. The time has come for policy to adjust, a volatile yet positive stock market and bond market performance continues. Let's get going. Welcome to August's monthly economic update. I'm Stephen Tuckwood, Director of Investments here at Modern Wealth. Let's get going. During a speech at Jackson Hole this month, the Fed chair made this statement: "The time has come for policy to adjust." The implications are that the Fed will no longer maintain short-term rates at current levels, but will begin a rate-cutting cycle when the FOMC reconvenes in September. He went on to say that the direction of travel is clear and that the timing and pace of rate cuts will depend on incoming data, and that with an appropriate dialing back of policy restraint, they think there's a good reason to believe that the economy will get back to 2% inflation while maintaining a strong labor market. They also believe that the current level of their policy rate gives them ample room to respond to any risks they may face, including the risks of further weakness in the labor market, end quote. So very much a monumental Jackson Hole speech by the Fed that makes a rate cut on September 18th almost certain. August was a volatile month for the stock market, marked by significant fluctuations and notable events. Early in the month, concerns about a potential recession and a spillover effects from the unwind of the Japanese yen carry trade led to sharp declines across major indices. However, as the month progressed, investor sentiment improved, driven by expectations that the Federal Reserve might soon cut interest rates. Despite the initial downturn, the S&P 500 recorded its fourth consecutive winning month. Small cap stocks underperformed following a very strong showing in July, and developed international stocks outperformed despite the extreme volatility that we saw in Japan. Overall, the stock market showed resilience, ending the month on a positive note despite early turbulence. Turning to the bond market, US Treasuries saw a positive total return of 1.3%, marking the fourth consecutive month of gains. This too was driven by expectations of future interest rate cuts by the Federal Reserve. The corporate bond market also performed well, benefiting from lower yields and improved credit conditions. Overall, the bond market showed resilience in August, with positive returns across several segments despite economic uncertainties. And finally, in August, the Treasury yield curve experienced notable movements, with shorter-term yields seeing significant declines. Longer-term yields also decreased, though less dramatically, with a 30-year yield dropping by only a few basis points. These changes were influenced by market expectations around Federal Reserve policies and broader economic conditions. As the Fed embarks on its rate-cutting cycle, we anticipate further flattening of the yield curve, followed by the eventual, more normalized upwardly slope. I've been Stephen Tuckwood, Director of Investments here at Modern Wealth. Thank you for joining us, and we look forward to seeing you again next month. If you like this video, please like, share, and subscribe.